Hey, welcome everybody. Episode 230 of the Winning Momentum podcast. Thank you for joining us. In episode 228, 2 episodes ago, I discussed the warnings of investor Kevin O'Leary, Mr. Wonderful, about the availability of capital to medium and small businesses. And the argument of Kevin's was that they're starting with the bank failures in the United States, starting with Silicon Valley Bank in particular, it caused regional banks to come under significant pressure. And the bottom line is that they don't know what their capital needs are. They're unable to calculate, to estimate what their needs are going to be in their future. They don't know their deposit base because deposits are fleeing to safer, larger banks. And they don't know the value of their loan book because of inflation and interest rates. And they have heavy exposure to commercial real estate, and who knows what's going to happen in commercial real estate. So there's uncertainty for those regional banks, and as a result, the books are closed. They're not lending. And for medium and small businesses, that is a problem. So according to Kevin O'Leary, no medium and small business is getting any lending in the U.S. at all. It's over. It's done for now. And they have to move to the gray market, my word, not his market, but to private debt. He suggested factoring, but I think he missed this whole world of private debt. And that's what I want to talk about today. When I did my episode on that, 228, you can look it up on any of the platforms that you listen to podcasts, and you can go through that. People seem to like that episode. You know, I walked through the experience of and a forecast of what's going to happen about banks needing to get their assets off their books. In other words, if you run a medium or small business, you need to be aware of them calling your loan and trying to get monetized on that borrowers separately at the same time are struggling. They're struggling because of the cost of debt. Interest rates have gone up substantially, more than doubled in many cases, and inflation has gone up, which is causing problems on margins and therefore profitability. And all of this is a problem for borrowers and therefore banks, and it feeds a cycle of negativity. That's what we did in 228. Now we're on 230 today, and the answer to this, in some part, is private debt, as Mr. Wonderful said. And what is that? Is that a good thing? Is it going to help borrowers in the U.S.? Is it going to help borrowers in Canada? And to understand that, who better to help us understand private debt and what lenders think and what borrowers can do than my friend Alex Burlatschenko. Have I pronounced that properly, Alex? I want to make sure we all know how to say that exactly properly on the air.
You got it bang on, Scott. Good job.
Excellent. Welcome to the show. Alex is Vice President of Cortland Credit Group, a private debt fund operating in the U.S. and Canada, although I believe you have some global exposure as well. And interesting, Alex has big bank experience prior to that. So it's not just a private debt perspective, but also large lender perspective as well. So again, Alex, welcome to the show. I'm happy you can be here to walk us through your experience and thoughts on these matters.
Thanks for having me, Scott. Really appreciate being here today.
Excellent. So let's start with background and context, and first, your personal background, so the audience figures out who you are. And then after that, when I'm done my questions on you personally, we'll move into your current gig, and we can talk a little bit about that as well. But really, from a context, could you walk us through your personal background and expertise?
Yeah, no, for sure. Thanks, Scott. I spent about 15 years at the Royal Bank of Canada, Canada's largest bank. Started my career right out of university. Is a small business lender, looking at small businesses, lending anywhere from $250,000, and then making my way through time, moving to the commercial and corporate bank. So did a few stints on a few portfolios, covered a variety of industries, from anything B2B, business services, did a stint in a retail consumer products portfolio, and ultimately ended up my career as a director in a corporate group, looking at large corporates as well as large government agencies. So, fast forward, kind of did my time there, spent some time plugging off things like the CFA designation and the Ivy MBA program, and just kind of felt myself there was a little more to do in terms of the lending space, and just being a bit of a self-proclaimed deal junkie, I thought to myself, after 15 years, what the heck, I'm going to try something different And, if I don't do it before I'm 40, I just won't do it. So joined Cortland as a private credit fund. And we're just really interested in looking at transactions anywhere sort of across the world, both sort of across various industries. But personally, I'm a family man here in Toronto. I've got a 5-year-old son, and married for about last 8 years now.
Excellent. And just for we have an international audience. The Ivy MBA is a Canadian. That's about as top as you get, Ivy League from a U.S. language perspective, just to put some context into that. So RBC, was the MBA, RBC, Cortland. Now I'm going to weave into this show, Alex. We had a number of listener questions come at us, predominantly on LinkedIn. So I'm going to throw some of those at you in the right sections. It's close enough. And one of the listener questions we had was, why did you get into this industry? So you graduate from school. Why banking? How did you become a deal junkie?
Yeah, that's actually a good question. I was actually a BCom focusing on marketing management, and it's kind of a crazy thing. Honestly, I never excelled at things like accounting and financial accounting in high school. I remember my dad shockingly said, "You got to get those accounting courses." I said, "There's no way I'll ever use financial analysis or ratio analysis. I'm a marketing guy." So funny enough, spend my 4 years looking at a marketing program. I ended up doing a couple co-op and internships, primarily at Kraft Foods, and I was a coffee and cookie marketer. And I got to tell you, it was a great gig. It just felt like in marketing there was a lot of mystical unknowns. You deal with product pricing, packaging, placement. And what happens if all that you get that right, but somebody just happens to have their kid pick up that kind of brand of cookies. And so me, there was a lot of just unknowns, and I'm just kind of a guy that likes to understand the inputs and the outputs. And so as I was just finishing off my co-op degrees, just was chatting with a few friends who ironically were at the Royal Bank, and I said, listen, there are great opportunities in relationship management, and with the financial side, really kind of what you put into is what you can get out of it. And I just sort of fell in love with that, and been a client-facing person. I've enjoyed watching businesses succeed. It's fun seeing them. You're on the highway, you see the trucks, you pass by the factory, you see the brands in the store, and just felt like as a bit of a an entrepreneurial spirit, that was sort of the best way to kind of share the successes and stay in the business community.
I too have a 4-year marketing degree, and
there you go.
I got hired by an accounting firm and did my accounting courses at night to catch up. So I feel like we have a similar path there. And the part B to that question was a lot of our audience is actually younger students, early young professionals. At your current firm, again, this is from a listener, at your current firm, Cortland, which we'll talk about in a second, where do you hire from? I don't mean the schools, but what fields? Because you're not hiring marketing grads. How does a young professional get into this space?
Yeah, no, absolutely. Look, I think, probably similar to you, I didn't do an accounting background, but I knew at some point, being in the financial services community, I was interested in leveling up on sort of my financial acumen. So somebody gave me the advice many years ago to go and tackle the CFA designation, the Chartered Financial Analyst. If you really want to be taken seriously, they said that's sort of the the creme de la creme. You got to sort of pursue these kind of options. So I put in the work. It took me years and years. Absolutely. I think folks that we're hiring today probably have a bit of a bent on financials from the accounting side. Certainly for things like due diligence and understanding financial models. What is a balance sheet?
Exactly.
I think if you need to sort of understand sort of the basics.
Yeah, I agree. And you could do that if you graduated from some minor that didn't, an honors in whatever, but it's not directly applicable. You could do that as you did, and I did, through different certifications while you're at your first job. Let's move on to Cortland. And the full name there is what? Cortland, I have it here somewhere. You'll have to tell me. Oh, there we go. Cortland Credit Group, Inc.
You got it. Yeah, exactly.
Tell our audience about that for some context.
Yeah, no, absolutely. Very interesting place to work. We just celebrated 10 years in business. Really, the genesis was two founders, Sean Rochester and Bruce Shirk. Sean had come from a background at the Teachers Pension Plan. Bruce is a bit of an entrepreneur, focusing on sort of credit, financial services. I don't know. I have to ask Sean how true this is, but Cortland is really an Apple, and so I'm thinking Sean, Teachers Pension. There's sort of the Apple logo there, so I think there's sort of that piece, and I think they were trying to cook something up and do something sort of internally, but started with a very modest means out in Oakville. Started raising some capital, and really we're trying to deliver a very liquid investment within a traditionally illiquid asset class. And so, I think they've always been really focused on providing diversification for institutional investors. Several years later, they they brought on another partner, James Kelly, who came from the institutional sales background, strong relationships with investors, and kind of the rest is history. I was employee 16, May 2021. We're up to almost 40 people now, managing close to 1.3 billion in assets under management. And really, we're looking at short-term private credit. I call sort of growth and transition companies, either growing really quickly, need to access capital, or sometimes have a bit of a transition from some sort of external factors, as you mentioned, Scott, like things like the capital markets are a little bit disintermediated in the U.S. regional side. We've seen opportunity to step in. I would say we're trying to foster companies, not fully adopt them, but give them that sort of runway that they need to kind of get back on their feet. And once things normalize, we're generally paid back by another senior lender or some form of liquidity event. So it's really short tenor, short term, a little bit more creative, we'll call it, but focused on asset-based lending.
And you define short term as what?
We generally say 1 to 3 years is really a short tenor for us.
Right. And you can disclose your range of possible rates if you want or not, but it is true to say that even when economic times are normal, you're above, big bank, typical conservative loan rates, because that is reflective of the amount of risk that you're prepared to take. Is that true?
Oh, absolutely. Absolutely. Yeah. We're, the way we underwrite, I think we're looking at slightly higher risk scenarios. I mean, I would say arguably that we are set up to monitor and manage those risks in a little bit of a different fashion, so we can accept and tolerate a different level of risk. Again, but huge focus on assets, huge focus on cash flows. I'd say in the broad spectrum, we're pricing incrementally from the banks, so we're not taking really a huge leap of faith in terms of some esoteric asset or some form of risk. We're really trying to find scenarios where we maybe disagree with, let's say, the bank's sort of analysis of where the company's credit profile is. Because, I find as a corporate lender, I spent all these years arguing with the risk management guys, and they say, look, it's the last 2-3 years of historical financials. And I'd say, yeah, but, they're turning the corner, they're improving. They say, well, yeah, but we got to give a little bit of more weight to kind of what happened historically. So I think we're still trying to do that. We're just being a little more forward-looking. I would say, you drive a car, you're trying to look forward. You're not looking in the rear view only.
Right. I had a listener question on Cortland as well, which is, how do you differentiate yourself from other lenders? I'm going to say private lenders to make that a little bit more narrow for you. So when you're speaking with potential borrowers, what's different about Cortland versus XYZ private lender?
Yeah, that's great. I mean, I think most importantly, when I talk to bankers or just the general public about private credit, number one, it's a very, very fragmented market. Every lender has a bit of a unique focus, whether it's asset driven, sector driven, geography based. I'd say for us, we're different in that we say that we're probably at the shorter duration. Not a lot of institutional level lenders want to commit capital on such a short basis. Most of the credit funds are closed-ended. They want to raise money and kind of lock it up for 5 years. So say, listen, you're going to pay 10 to 15% for 5 years. We're saying, listen, like if you really have some conviction, call it maybe in that sort of 10 to 12% range, you can sort of get in and rightfully get out rather quickly. So,
Right.
I think duration is key, but also I think the ability to look at assets outside of Canada, let's say in North America, Western Europe to some degree, and maybe some sort of unique sectors that we've looked at from time to time.
Great. I want to move on to, the economy in terms of availability of capital for medium and smaller businesses, which is your market. And by the way, on Cortland, do you want to talk about deal size, just to try to frame this for people in your experience? Although at Royal Bank, You've done much in your career, you've done way smaller transactions as well.
Yeah, well, I've done sort of the whole spectrum. Like I said, from my early days, from sort of $250,000 to sort of the end of the corporate groups, that's sort of 100 million plus. I'd say Cortland falls, somewhere in the middle there. We're looking at really minimum deal size of $10 million as a Canadian equivalent. Generally ballparking 50, 75 million, that range. Certainly we've stretched on some exposures as we've sort of grown, but I think we want to be coming in sort of that 10 to 50 million as initial commitment.
Right.
And if there's a way to grow those relationships, we'll sometimes stretch beyond that.
Right. So in Canada, that would be defined as a decent mid-market loan, and in the U.S., maybe upper small business loan. Agreed? If people are looking to put language to that. So in the U.S., what are your thoughts on the Kevin O'Leary analysis? The regional banks have closed their books. They're looking to collect. Your only choice is private debt. If that's true, you would be seeing a lot of activity, I would think, in the U.S. What are you seeing in the market?
Yeah, I think he's right to a degree. I think, I think like the challenge been, I post a lot about this on LinkedIn. There are just endless articles around, regional bank liquidity, and it's trickled down right to equity prices of the big banks. There's a lot of sense of sort of nervousness in some of those markets. And so I think like the challenge is there are still a lot of really good companies, but the companies maybe aren't able to access the capacity, sort of the amount of capital they are looking for. So, we've seen situations where a company is maybe looking for, let's call it $30 million. The bank is saying, listen, we're only comfortable at 20. We've got some capital we need to set aside for regulations. Or, like as a contrast in Canada, we've got only a handful of big banks down there, very, very fragmented. So, it's not uncommon to have a company banking with a small regional bank local to their community. And they really just want to have a little more diversification. They aren't comfortable in holding too much exposure to a single unit. We looked at a company up in Alaska one time, and they're the largest customer of that small bank. And so, there are interesting opportunities like that for us to get into. And again, with some of the large national banks in the U.S., they really want to have, good, strong, stable, reoccurring earnings. And, like with the COVID years, the supply chain issues, like you name it, extreme weather is going on. There are so many things that cause sort of bleeps on the financials. And, sometimes if you blow a covenant or you're a little bit offside, sometimes, they're just a little bit less tolerance these days. So we've certainly seen our fair share of opportunities in that market.
And in the Canadian market, the ecosystem in finance is entirely different. The banking ecosystem, I would say it's a lot more dominated by a handful of really, really large financial institutions who are pretty stable for the most part. And so we don't have those same sort of dynamics as in the U.S. What are you seeing happening in Canada right now? Because we do have the same inflation and interest rate pressures.
Yeah, absolutely. I just did a presentation yesterday morning on this exact issue, but I pulled some stats from the Bank of Canada, and they were showing that the confidence in sort of the Canadian landscape or sort of the Canadian bank landscape is still very, very strong. A lot of confidence, and I pulled out a really nice graph, and it showed the growth in deposits across the major FIs in Canada, and it just almost doubled. It's coming out at something like $681 billion of liquidity. So, it just goes to say that there's so much capital amongst the big banks in Canada. It's just more of a form of Do they want to continue lending? Do they want what businesses they want to support? And so, interestingly enough, in Canada, my personal view is that we've actually been a little bit less successful in winning transactions where the Canadian Bank still stepped in from some of the larger sort of corporate names. I think if you're a small business, I think a little bit of a different story. There's some interesting stats too, where in despite all this liquidity, I think still about BDO quoted about 40% of the transactions in the Canadian business credit market was still done by non-bank lenders. So wow. You just kind of scratch your head and say, like, why does that make sense with all that liquidity?
Yeah, exactly. One thing we've kind of jumped ahead on my list here, which is great. I have talked about on this show many times and published my top 10 checklist or tip list for how to refinance a troubled situation. And down on that list is the need to understand that there's an entire universe of private debt and equity for that matter, but relevant to this conversation, private debt institutions that want to lend to you specifically for these unique situations. And my experience is that your average owner manager of a mid-market, smaller company doesn't even know that this asset class exists. What are your thoughts? Yet it's a booming industry from someone on the lending side. You look at this as a really explosive asset class. What are your thoughts on that?
It's surprising. It's surprising. It's shocking. Again, as an RBC former corporate banker, like I am just still amazed at how many individual credit shops there are, across Canada, across the U.S. I'm just astonished at how much credit is done to these institutions. I always thought, you're a big bank, it's sort of the end all be all. There's the debt side and there's the equity side, and that's it. And one thing I've learned is that every firm has a focus, again, whether it's underwriting the asset or underwriting the situation or looking at the geography. And so, even now it's interesting. It's a very difficult market to navigate if you're not really in it. So, it's about asking the right questions, finding the right professionals, and trying to connect the dots. But there's plenty of capital, it seems, out there. It's just about finding the right fit for the right opportunity at the right time.
Should companies have an advisor who understands the space to try to help them focus in on the right fit?
I think if they're going through, again, either that growth or transition plan and they're having a little bit of maybe negative experience with their traditional lender, I think certainly having an advisor has probably benefited some of the transactions. I think having that level of information packaged properly, it's almost like translating. There's a lot of information at a company.
But the question isn't really into the quality of the package you're seeing. We're actually going to get to that. But if you see 100 deals, I'm willing to bet that 80 of them are not the business you're in.
Oh, yeah, no, absolutely.
Because the prospective borrower doesn't understand the space.
Yeah, you're right. And so, with that level of volume, you go through them really quickly. So, if they're not presented accurately, it can be a little bit tricky.
Right. So as an advisor to businesses, no, I'm kidding. I'm not trying to get you to jump on that bandwagon, but businesses in that situation, they need to understand what their prospective counterparty does for a living. I think that's important and fundamental.
100%. I totally agree. Yeah. And I think, again, navigating those waters, someone, chartering and pushing that. Look, I think the problem is, and, if you're a business owner, and especially at a sort of maybe a smaller business or a mid-sized business, you're running nonstop. You're wearing multiple hats. You're putting out fires. Sometimes it's not that time to come up for air. So I think absolutely, hugely important to find the experts and ask the questions and try to connect to whom you're trying to connect with.
Right. You spoke sort of following that point, and you spoke earlier about the fragmentation within the space. There's a whole bunch of different types of lending that fall into this private debt category. Can you talk about some of those? So that would be outside of Cortland, but what Cortland does as well specifically, but outside of that as well, because really, to me, for almost any type of business in almost any industry of almost any deal size, there's a product available for you if you have a good plan and credibility.
I agree. Look, arguably, you could say that anything in private credit could be an individual lawyer writing a private mortgage to an individual, right up sort of the institutional level. So it's really a broad spectrum. And so,
but it would include asset-based lending and term loans.
Absolutely. Factoring, asset-based lending, real estate lending, land development, or just raw land finance. Specifically in the U.S. market, there are so many different investors that want access to various asset classes and exposures. And so it's really just about finding the right partners that are aligned with your strategy.
So the overall message of what we just discussed from my perspective for listeners is that there is capital available. Just because your bank wants to move out of that space or is unhappy with your current predicament in this environment, there are places to go. That's what I was trying to communicate there.
Yeah, if I could throw another stat at you real quick, I would love to. But again, doing some research over the last couple of weeks, pulled out some information from Vistra, just looking at the global private credit markets. In 2010, the market's worth about $250 billion. Today, we're looking at $1.4 trillion and expected to grow in 2027 to over $2.3 trillion. So, there's a lot of capital moving into these markets. And interestingly enough, in the U.S. side, you're seeing some of the banks like Barclays look at allocating capital to private credit. So it's really a hot space. There is capital out there. It's about searching them out.
Right. So let's now go to the borrower side and the borrower pressure in this economy, which really boils down to interest rates and inflation. The two of those things combining to cause borrowers to move from profitability, if they ever had any, to losses, tighten margins, blowing through lender covenants. And, on the tightening of margin side, on this channel, on my shows and the things that I publish, I talk often about the most important KPI usually boils down to contribution margin. And in a manufacturing, so if you're experienced at building financial models, you can have a million different assumptions that you need to code into this beast for the next 5 years. But at the end of the day, it all boils down to 3 to 5 key assumptions. The entire business runs off 3 to 5 key assumptions, and everything else is noise. And almost always, one of those key assumptions is contribution margin, which, for those in the audience that are familiar with that term, is not your gross margin at all. It is sales minus, so your revenue minus your variable costs. If you sell a widget for $10 and you bought it for $5, you have a 50% contribution margin. You make $5 on every widget, every unit, and that $5 contributes to pay everything else, your overheads in your business. That's kind of what that term means. Very, very important. And with inflation, particularly on the manufacturing side, if you're buying commodities as an input, well, I have a couple of companies that we own in our portfolio in that space, and our input on the commodities have gone up. Coming out of COVID, they went up 50%, 100%. And so the unit cost on the buy side doubled, right? But you can't pass that through, or you can't pass it through in whole, or you can't pass it through quick enough to your customers to protect that margin. Because if your contribution margin is the most important sensitive variable to earning profit, it is also equally the most sensitive variable to losing money. And so as it contributes, you're really in trouble. So there's an example of what happens on the inflation side. And on the interest side, I gave an example a couple of episodes ago, but just to refresh the audience and for you, Alex, I was pointing out that if you had a hypothetical, let's say $10 million loan, and for the audience, I know some of you have much larger businesses, some of you have much smaller businesses. You can add zeros to that 10, you can take off zeros from that 10. I don't care if it's $100,000, but in our example, we'll use a $10 million loan at 6%. is a 600,000 if it's interest only, that's 600,000 of interest and debt service that you need to pay a year. And let's say, for example, you're making $1 million of free cash out of your business like clockwork before you pay your debt service, your $600,000. Well, now you pay your 600,000, you have 400,000 left over, you made some profit, and your debt service ratio, the amount of free cash you have versus the amount you need to use to pay your debt service, comes out to 1.67 in that particular example, which is fine. You've probably made a covenant in your loan agreement with your big bank for 1.25 or 1.5 times, somewhere in that range. Does that sound right, Alex? I would say.
Bang on.
I would say. And so, and by the way, a covenant, for those of you not legally minded, is a promise. It's a contractual promise, and when you break it, you've defaulted. Doesn't mean they're going to put you down, but it's an early trigger warning for a bank to take a look at things. And so you've got a 1.67 in this hypothetical example, and your covenant was probably 1.25. Now your interest rate goes from 6% to 11% because they're trying to fight inflation. Okay, so now your payment's 1.1 million per year out of the million that you have to pay the 1.1 million. So you've gone from positive 400 to negative 100,000 in earnings. You don't have enough cash unless you've saved up equity in your business to pay your interest, and your debt service ratio is dropped below 1. So you've blown through this covenant of 1.25, and all of a sudden your great business, which hasn't changed, is a troubled company, specifically because interest rates went up, right? And so that is an example for those that haven't thought through how this can be such a serious issue for the economy. That's an example of what can happen. And it happens at a time when the bank is worried about its own loan book. It's worried about getting rid of things, de-risking its exposure to certain industries. So you just blew through your covenant. The bank's thinking, maybe I don't want to be in your business anyways, right? And fundamentally, your business hasn't changed. Now the bank wants out. And so the borrower, what do they have to do? They have to come to private debt. So my question to you is, do you agree with all of that analysis? And are you seeing this scenario play out in the marketplace? Are you seeing other scenarios that are adding to this, that borrowers are struggling, maybe even within your own portfolio?
Yeah, no, I think you're spot on. I think there's some differences between the Canadian banks and the U.S. banks. I think, if I can be so bold, I believe that the Canadian banks have been a little bit more forgiving recently in some of the covenants. Because they
can afford to be.
They can, yeah. And I think, it's a different market, it's a much smaller market. There's a lot of, we're all in the same boat here, right? So I think, there's maybe a little bit more tolerance. I mean, certainly we've had a lot of liquidity from the federal support. Sort of, kind of continue pushing this on. But no, absolutely. I think when it comes to inflationary pressures, we've seen many of these. We looked at a company, middle of COVID that, and actually, well, I'd say it's a large mid-market company in Eastern Canada. They had gone through, some issues with some of their costs. They were under fixed price contracts with their customers, which were large corporate customers, bought a lot of volume, had a lot of say in price negotiations. And furthermore, they were facing issues with labor costs. You can remember back in the COVID days, you had sort of these crews that, one guy got COVID, he had to go home. And so you have these large, swing factors and things like labor pushing on margin and profitability. And so, maybe 1 year, 2 years, the bank says, okay, let's tolerate it. Let's get a waiver in there. Second year, nothing's changed. And, by the third year, it's like, okay, like we've got to have a good conversation here. So, absolutely. I think in some situations they've been able to refinance and stay with the banking market. Again, some have been a little more forgiving than others, depending on how critical maybe that business is to a certain community. Or how deep the relationship goes. I'd say, there's a lot of political power that is beneficial with some of the banks too. But some we've seen, good companies. We looked at a company out in Western Canada as well. Also, mid-market business, many years in the industry, in the sector. strong sales order, but they couldn't get critical components like semiconductors. They couldn't translate their inventory into finished goods. And as a result, cash flow dried up. EBITDA went negative. Bank fully just pulled the handbrake on the revolving line of credit and said, "Sorry, guys, you got to raise some equity, or prove to us." Now, luckily, they got a bit of a credit enhancement from one of the federal programs, and luckily, but like we're talking 11th hour. This is like a really panicked situation, and so there are some situations that until you have that normalized recurring revenue of 2 to 3 years, that the banks are saying no, we'll take a bit of a wait and see here. And so, I think with us, have to have enough conviction that there's a strong management team there to go in and negotiate and pass on pricing inflation. I'm sorry. Push that on and ability to maybe make some tough calls with, how they're running their business, cut some costs. And, to your point, if there's negative contribution margin, maybe you shouldn't be in that business. And so let's kind of pivot. And so, we're trying to focus in.
Negative contribution margin, extreme example, but even just the easy example that I hypothetically threw out with a profitable company that, just because of interest rates and nothing else, has turned to a negative company, unprofitable company that can't afford to service its debt. I'm willing to bet that if you had a handful of those come to you, there would be a significant portion. If you had 10 of those types deals come to you, I bet you 7 or 8 of those, their entire business plan would be to lend me money and we'll wait till the economy goes back to where it ought to be, as opposed to making those hard decisions.
Yeah, you're right. No, and look, I think based on your background, Scott, you can't really just throw good money after bad money and just hope that things will turn around. You've got to have a really good view that management has accepted what's happened and what they need to do, what's the heavy lifting they need to do. And, but by no means do we really focus on restructurings and large-scale turnarounds. There are certain lenders that do look at that, but I think the point I'm making is that if management really hasn't taken a sharp look and sharpened the pencil at the pro formas, and I don't think any kind of financing will really solve that business. You can't wait that thing out. Something structurally has to change.
You've hit on one of my pet peeves, or maybe 2 of them. As you might know, in my career in the Canadian market, I've been probably one of the most active troubled company refinancers through your type of product over the last 30 years. And we're the number 1 brand in the country for mid-market and smaller turnaround, not insolvency work, but turnaround, actually going in and working with companies to get out of the trouble that they're in. And I've also, because I've developed over the 30 odd years a name in that space, I've become a advisor to funds such as yours from time to time. Not yours, but such as yours from time to time. And one of my pet peeves that just drives me nuts is the idea of, number 1, we're financing restructurings, right? So a restructuring, for the audience, is you're reducing the amount of debt to pay out to past creditors, but rarely the interest-bearing debt. That's always the unsecured and the suppliers. And so you're sort of resetting to a healthier place on your balance sheet, but you have done nothing to deal with the fact that you're not making enough money to service the new debt, right? You haven't changed anything. And that's always a problem. And my second pet peeve, which sort of leads to the same thing, is you've got a troubled company come in and you're like, hey, yay, I got a new deal. I can issue a bunch more money on an asset-based loan because that gives me more, the ability to issue more capital in the same group of assets. And I keep saying, well, all you're doing is giving the same management team more money. What do you think is going to change? Right.
Exactly.
Yeah. Okay. We're on the same page.
No, Totally. Yeah. I think it's a valid point. And, and I think probably today, and I'm sure we're going to go there in a second. I think today more than ever, it's really important to have management really prepare some very sharp pro formas and expectations of, what's changing, what we're doing to change or sort of right size in light of this heightened interest rate environment, which doesn't seem to be going away too quickly.
Well, it won't go away until administrations change, right? I mean, that's the inflation is driven by policy. There's all sorts of other reasons, but to a large degree, it's driven by policy, and so for it to change back, policy has to change, and that's not going to happen until administration changes. And even an administration change isn't a guarantee. But the one thing we know for a fact is it's not going to change with the current set of policies in either country. I'm not picking on any particular politician, but it's just not going to happen. For listeners, you can go back to episode 228. I have my top 10 tips for refinancing a troubled business. And to your point, Alex, number one on that is you need to start by admitting that you're in trouble. You need to admit that to yourself, to your employees, to your stakeholders, to prospects, right? If I'm coming to you with a deal of a troubled company, I'm going to say, hey man, this thing used to be good and then it wasn't, and they're in trouble. And this is what happened, which is point two. But unless you can admit to yourself that you're in trouble, you can't make those hard decisions. You can't decide you need to break that fixed contract that's killing you in this economic environment. You can't decide that you need to restructure. You can't, get rid of that employee that's underperforming but is great to have, or the ego asset that you ought to be liquidating and paying down some of your debt. Like you can't make any of those decisions unless you've mentally shifted to, okay, this is serious now. It's the business equivalent of hitting rock bottom.
Totally. Yeah. And, the example I referenced out in Atlanta, Canada, this management team, kudos to them. They had to have some really tough conversations with some really important customers. Said, guys, listen, times have changed. The cost for input has gone up. We have to pass on some form of price increase here. And they did it. And so, nobody wants to ruffle some feathers, but, I think it's hugely important to have those strong leaders and managers to be able to push through those.
Some listener questions on these points. I'll just, in the interest of time, I won't go through them all because there's a lot, but engaging with borrowers, when you're assessing prospective borrowers, how much due diligence do you do on the individuals, the management team, outside of intake questionnaires? I know the answer to this, I believe, but why don't you walk the audience through that?
Yeah, no, that is definitely interesting. I think my perspective, and this is my own perspective, I think that it's enhanced in the private credit space compared to some of the banking space. I think, management character is probably one of the most important. We go back to the 5 C's of credit. Character, to me is always number one. And I think certainly that, histories of fraud or misconduct, I think, it can be a really easy deal killer. That's point blank.
But you're is part of your intake, your credit analysis, are you doing investigative, what's the right word for that? Are you hiring Grant Thornton or whoever to do an investigative review for you? We start in sort of a multiple stage, and certainly part of our early stages involve a scrub and to check on manage. Absolutely. We don't want to sort of get into the 11th hour, but absolutely there's definitely some front loaded diligence. Super typical with asset-based lenders, particularly in the private debt space. So the question here framed it as, are you Googling the names of management directors? It's way beyond that. It goes into hiring literal detectives to go in and issue a report on everything, right?
Mm-hmm.
How important is, so this is touches on some, in your lending criteria, some, what would be the right word? Some current social type issues like job preservation, onshore retention, ESG. Like, do you think about any of these things in your lending criteria?
Yeah, no, we do. I mean, it's fair. I think, I pulled some stats on ESG as an example too. I think what I'm seeing, and again, this is from the public domain, I think there was probably a really big push in, 21, 22 I think it's come down a little bit, but I think still, really important. I think specifically, if I could hone in, I think it would be on the governance side. We definitely want to see good governance internally, management internal controls. And certainly at our end, we do ask the questions. We do screen. What are you doing for sort of environmental compliance? What are you doing for sort of social benefits? And what does your governance structure look like? I don't think a lot of the private credit funds will just really lend because you're, doing good sort of social work and you're not making money. Again, it comes down to, we are a business and, our business model is to lend and get our money back. So, right. But yes, I would say that over my tenure, the ESG screen has certainly become more prevalent.
And probably much more important with larger institutions, right?
Yeah. I think as a negative screen, it's pretty quick. We don't want to be involved in businesses that are maybe negatively seen to be polluting. As small organizations, we want to be quite careful of our own reputational risk or perceived reputational risk.
Right. Okay. So we've talked about when a medium or smaller business needs to refinance, needs extra capital, the economy's gone against them, their margins are tightened, that private debt is available more than likely. And we've talked about what a private lender might be looking for from them. Not in great detail because we don't have a lot of time for that in one episode, but the idea that there has to be change. They have to admit they're in trouble. They've got to come forward with a plan. And you could accept probably some losses and a little bit of underwater in the short term, as long as there's a plan and credibility behind that plan. Now, it's short-term credit, as you said. I think you said 1 year to 3 years, somewhere like in that range. And we've already agreed that the interest rates are a little higher than the norm to deal with the risk, to deal with the fact that you're accepting that client, that prospective borrower, as when they're a little bit underwater and you're financing a plan. Do you think of that as a bridge, in a sense, a transition-oriented financing as opposed to a permanent lender?
Yeah, I think there's a few ways to position it. I think I'm quite careful on how I position it. I think number one, I say, is it a bridge or is it a pier? And a bridge will take you somewhere, and leads you right down to the ocean. But I like to use, as a parent, I like to use the analogy of fostering. We're not trying to adopt these companies. We are trying to foster them, get them to a good place, let them mature. And then sort of move off the books. And so, it's really high growth companies that, maybe have some exponential growth and don't have the ability to maybe finance the working capital because it's just moving so quickly and they're really onto something. Or again, sometimes it's been a little bit more negative. They've just sort of got into a situation. Maybe they're under collateralized on something, and they do have good visibility on cash flows, but they're just a little bit outside the banking box. And some of those boxes are pretty small, so you can't always fit a round hole, a square peg in a round hole.
Yeah, exactly. So from a borrower's perspective, from those in the audience with businesses that need to refinance, the rates on private debt are often a little bit higher, or they could be way higher. I mean, factoring, I don't know. What could factoring be these days? It's got to start with a 3, I would think.
It could. It definitely could. Yeah, depending on the size and the duration. Yeah, absolutely.
Yeah, right. And so no business can go along and pay that forever. You need to view this as a transitionary solution, not a permanent, this is my new bank, right? This needs to be and transition to what, as Alex said. Like that's the point. There has to be a plan that this money gets you to. I've told this story before, but back in the day, when I was in Toronto working on Bay Street with whatever company I had back then in advising businesses that were in trouble, there was really the founder of this type of product in Canada, and back then their money was 18%, and when they had a smaller amount of assets under management than you have, but still a decent amount for those days, I was a decent amount of their book. And it was a very, very high. I think it was 18% back then, unless you're in default, and then it was 22. And you say to a client, like, nobody can afford to pay 18% forever. That's crazy. But if it's if 18% is 10% more than you used to pay when you got in trouble, and if it's a $10 million facility, then that's $1 million for a year of a fee to have access to capital to get yourself out of the trouble that you're in, and you haven't lost your business, right? And you haven't diluted all your equity, right? You've given yourself a shot, right? That's a way more extreme and expensive example than what you do at Cortland. So I'm not trying to associate those two, but the mindset from a borrower should be the same, that it's a transition.
Yeah, no, absolutely. What will this new business line, this new segment, this new strategy, what will that do incrementally to your market share, your position, your growth plans? Absolutely. You're really leveraging this strategy as really fuel to continue your growth. And absolutely, when things normalize to more of a traditional leverage or traditional, let's say, a cash flow, then absolutely, you should be seeking to find a long-term pseudo lender. Absolutely.
Excellent. I want to move on now to personal branding, but before we do, anything else on private debt before we move and change topics?
Well, Scott, I could go on forever, so I think we probably hit sort of the nuts and bolts there, but I'll leave it at that.
All right. You are active on LinkedIn, and I don't want to put words in your mouth, but perhaps you're trying to position your career as a bit of a thought leader in the space on private debt or finance in general. I'm not sure what. What is it exactly that you're trying to accomplish, and why? Like, from a personal and a career perspective, what is that doing for you?
Yeah, that's great. Again, I think going back to what I said previously, I've been really amazed by the number of players in this market, and being in this segment, I've been really paying attention. And what I am trying to accomplish is really to just share some of my learnings. What is going on in industry? Are you paying attention? Did you realize that, some of these big banks are moving into private credit? And really just to sort of bring it on the horizon. The audience that I have in LinkedIn is really anything from financial professionals to business owners across the map. So it's really just sort of elevating that. And, junior bankers and folks in the accounting industry, folks in the law industry. That's simply, the rarest piece I'm trying to bring. There is really not a lot of tie-in in my posts in terms of what I do directly, but it's more of a FYI, this is what's happening in the North American private credit markets.
So that has a benefit to you in that you are sharing your expertise, which makes you feel good. And maybe not to Cortland directly because it's not directly related to what you do. Is that what I'm hearing?
Yeah, I think, again, what I mentioned too is these are very fragmented markets. And I always say, listen, I encourage a conversation, for business owners that don't really have maybe a deep, connections or contacts in the industry. I really am here to sort of field conversations, try to explain the landscape, try to help navigate. Not every deal that we see is, one that we'll do at Cortland. And so really, I think by creating a bit of an ecosystem and sharing opportunities and being that connector, I think really, long term, that's how you build relationships. That's how you build your brands, but obviously, how you sort of build the future here in this market.
Well, I'm going to try to make this a little bit stronger for the audience and people listening, if you don't mind. I would say two things. One is as you're building your career, and I don't mean that for you specifically, but younger professionals as well. As you're building your career, you need to build your credibility and your trust. And people, it's funny, I have guests come on this show and then they monitor how many calls they get off the show, right? And I tell them up front, you're probably going to get none, maybe one. Like, this is not a sales tool, but it is a marketing tool, because people will watch this and they will say, oh, well, this fellow Alex or this last guest that I had is really credible. He's very measured. I think you could add value to my particular situation, right? So it wasn't generating the lead, but it's way shortening the sales cycle. And that's really, really important in whatever business that you're in, is to differentiate yourself and become an expert in what you're doing. So that would be number one. And number two, sort of playing off this whole idea of giving back and adding value to the audience. In psychology, as it relates to sales, everybody thinks, well, I have to pitch competence, right? Everyone wants to know that I'm competent, but competence is like the entry level barrier. People don't buy from you from competence, because as humans, we value trust more than we value competence. Doesn't mean we want to hire somebody incompetent, but mostly we want somebody that we can trust. And more than trust is benevolence. We want to associate ourselves with somebody that is benevolent, that we think has their best interest in their hearts. That's what we want to associate and buy from. And when you're creating content that is adding value and giving back without a call to action associated with it, you're demonstrating that. And I think that's really important for other professionals looking to get into the space, or any space, for them to think about that.
Absolutely, and hopefully it's something of interest when you're amplifying that messaging. So, like I said, I find it really interesting. So, really, really intriguing.
Anything else I've missed before we head to the wrap up here, Alex?
Let's wrap it up.
This podcast is called the Winning Momentum Podcast for a reason. And what I want to ask you, I try to ask every guest, is your 1, 2, or 3 ways that you personally change momentum when things are not going the way that you want them to go, which happens to everybody in business or personal or relationships, whatever it is. It doesn't matter. When things aren't going well, how does Alex turn that around? What are some of your go-to tips for that?
Yeah, no, that's an interesting question. I think about this a lot. As a professional who's really tried to change his, I wouldn't say quite career, but really sort of evolve in the profession I'm in. I think you have to sort of be aware that there are good days and there are bad days, and I think it's really about focus. Continue focus on driving where you want to go, the results that you're going. Expect the unexpected, deal with those U-turns and sort of going off course. But I think, it's just about being resolute. It's about mindset. Things can match all the time. And I think it just, I think you brought up in one of your earlier podcasts, I think you brought up Elon Musk, and he just doesn't think about it. He just does the thing. You just do it, and you just keep on going forward.
Yeah. He doesn't think about, can I do it? Can I not do it? Am I going to fail? Am I going to succeed? It doesn't even compute. According to him, it doesn't even compute in his brain. It's just, here's something that's really, really important to do, so I'm just going to do it.
Mm-hmm. Absolutely. I'm a huge advocate of James Clear, Atomic Habits. And, he says consistency over intensity. And, I think I try to take that approach every day, right? Just be consistent in your approach, keep going at it, try to figure out what a good day looks like, and just try to replicate that as often as you can.
Alex, how and why should people reach you? Can and should.
Sorry.
How can people reach you, and why should they reach out to you?
Oh, absolutely. Yeah, absolutely. I think LinkedIn is probably the number one easiest way to get a hold of me. Alex Burlatschenko, if you can type it in correctly. Scott did a great job of pronouncing it.
It'll be spelled in the notes to the show for sure.
Yep. A Burlatschenko at CortlandCredit.ca. There's no U in Cortland, but LinkedIn is probably the easiest way to find me. You can check out the Cortland Credit website directly. You can find my name, my bio, and a link to get a hold of me there. I'm open to having conversations with individuals that are looking to learn about the industry, learn about their career. Maybe they're in sort of mid-career looking for a shift, or they're early stages. I do a lot of mentorship, anything from their career within the banks, the private credit markets, folks that are, contemplating going into the IB MBA program, happy to talk about those ideas, the CFA designation. But most importantly, I'm also really interested in chatting about the markets, and I love talking about deals. I love talking about businesses, how they make money. I love taking them apart. To me, it's like a puzzle. So any of those can apply. I'm really accessible. I'm reachable, and I do believe I'm quite responsive. So happy to always have a conversation.
Excellent. Thank you for that. Alex, I asked you for an hour, and I think I'm 10 seconds over. So I nailed it pretty well. I think we're done. Thank you very much for joining us on the Winning Momentum podcast. And thank you, everybody, for listening. This has been episode 230. And hey, you can give us a thumbs up or a like or a comment, or you can put in the notes some questions you would like me to address on future shows. And we're available everywhere that you listen to podcasts, including on YouTube, where the video version is. Thanks, everybody. We will see you next week.